Rising interest rates have changed the game for multifamily investors. The problem is many investors are still relying on old financing strategies that don't work in today's market. Higher borrowing costs impact cash flow, valuations, and deal structures, making it harder than ever to find great profitable deals. Today, we're going to break down how rising interest rates are affecting multifamily investing and the financing side of it, and what smart investors are doing to adapt. John, it's great to be here with you.
So good to be here, Mark. Excited for today's topic. This is an issue that is impacting a lot of current operators, right? Because they maybe took down some debt in the high times when interest rates were low and thought the party would never end, right? And so, really excited to dive into this topic because this is really impacting deals in a way that for some will cause pain, but for others can really create a lot of opportunity. And so looking forward to diving in deeper.
Yeah, for sure. And we're actually circling in on a deal right now. Actually, it's in Atlanta is what we're looking at. But for investors that are looking for a potential spot to invest in a really great deal, we're actually looking at one that has an assumption with lower interest rates right now. So those types of deals are more rare. But if you are interested, go to fariscapitalpartners.com and sign up to be able to get on our reservation list. And if you do that, you'll be the first to be informed when that next deal comes up, because there's only limited spots that are available. And it is only for high net worth individuals that are looking to come in. So if you're interested, fariscapitalpartners.com, come and visit and get on the list.
That's right.
So John, okay, so interest rates. This is where a lot of people, the gravy train was going, and it was going real well there for many years. And, you're all through those years, it's just like, rates are going to stay low, they're going to stay low forever. And if they do go up, they'll just go up slow. Well, that didn't happen. You had a lot of operators out there that were just depending on the gravy train going on forever. And then interest rates pretty much doubled within a number of months. And so this is where a lot of operators got caught up. And so we had to change our overall approach as a multifamily investor. And so we're going to dive in a little bit more into this as to, how we're structuring our deals today and how you can actually protect yourself in a market like this.
That's right. What comes to mind is, I'm kind of paraphrasing here, but Warren Buffett has this quote. It's like, be cautious when everybody else is greedy and be greedy when everybody else is cautious, right? And so there was a period of time, sort of post-pandemic, late 2020, early 21, and even early 22, rates started really rising rapidly in May of 22, where deals were trading at these absurdly low cap rates. And, lower cap rates, signal a strong market, but what it was also signaling is an overheated market. And so, that idea that the good times will never end, right? And so they thought that these rates would remain low. And the reality is, Mark, is the world is changing, and it's changing rapidly. We're seeing it today. There's a lot of deglobalization occurring. Post-pandemic, supply chains exposed a lot of flaws in the system, and so now we're hearing talk of tariffs and all these other things. So the world is changing, and part of it's being driven by there are just fewer people on the planet, and the baby boomers were the largest generation, and so what that means is there's just going to be less capital available to invest in the market. So I kind of think we're in a new normal here with these rates. I don't expect rates to drop, and I don't know that we'll ever see 2 and 3% interest rates again in the foreseeable future unless something really meaningful happens. And so, understanding that and just making sure that going forward, you're building your plan with those assumptions baked in will really protect you. But what I'm also excited about, Mark, is even today we were talking with our acquisitions director, Joe, and at our morning huddle, he shared that you're starting to see a lot of creativity coming in from lenders, right? And lenders are realizing that there's ways that they can restructure things with bridge financing, but with fixed rates, or even do a floating rate, but buy a rate cap. So there's ways in any market, if you're smart and you're creative and you have that like unwillingness to fail kind of mindset, you can still make these deals work. And so that goes back to that opportunity I spoke to at the top. Deals aren't penciling as easily as they once did, but this is the reality. And so a couple of things are happening. We're really seeing it in 2025. Owners that are selling are becoming more realistic. They finally realize that, look, the Fed reduced rates in the United States. The government of Canada reduced rates, but we actually saw rates go up in terms of what you can get from the agencies and from the lenders because of the fear of inflation with tariffs and some of these other things that are happening. And so, it's just the idea that, the sellers are finally realizing that they have to get realistic and that unfortunately maybe they made a bad investment decision. And so you hate it for those operators, but that's that opportunity that it's creating for newer groups coming in with a more disciplined approach.
Mm, for sure. I just pulled a report here, John, that showed the history from 71 to current and what the average interest rate was. And so 7.73 was the average. So we're actually under what the average was. I mean, back in
Right.
the 80s, that obviously pulls that average when it went up over 18%. But the reality there is that I totally agree. I think we're in the new normal now. And so the reality is that how you structure your deals with debt, if you're paying, for example, 6% interest versus 3%, well, the interest rate then becomes way more of a factor in how you're analyzing these deals, if they're cash flowing and what the overall projected returns are. And so it becomes, like you had said, you got to be more creative in how you're structuring these deals. And it's, half a point can make a massive difference,
That's
right?
right.
When you're in this level. So that's where making sure you have all the right connections and you have the best finance context that we'll call them that power partner, that becomes more important today than ever, that can actually find the best rates, but not only the best rates but the best terms as well when they're looking at your business plan. For example, what's the prepayment penalty, right? Yield maintenance, what does that actually look like as well? And so somebody that can understand how you're operating your business on a day to day and what your overall plans are for the exit, and to be able to help navigate you in to the right product becomes more important in today's market than ever.
That's right. I mean, what it boils down to is higher rates just mean higher cost of debt, which mean it has an impact on your NOI. But what also happens is the cap rates tend to follow interest rates. And so the values of the deals reduce a little bit, but when you're buying, that's an advantage because we get a great deal, right? So I think back on some of our previous acquisitions in this environment, our two deals in Charleston, we had a 27% discount to the peak of the marketplace. The other deal we just closed in Charleston was very similar. We had over 35% savings from the peak of that asset's value buying when we did. Now, what was beautiful is you mentioned this, in three of those four deals, we actually had assumable debt coming in. So even though they had nice interest rates, knowing that a future buyer may have a higher, we still were able to basically achieve a very great cost basis on these acquisitions. So as we've now been in the deals and the deals are performing above our pro forma, we're actually capturing rents in some cases $200, $300 more than we projected. We're going to have a great exit, bottom line, for our investors, even though we're in what some may consider a more challenging market. So that goes back to Warren Buffett. When everybody's cautious, maybe get a little greedy. And, it's something Joe and I talk a lot about. It's like we just have to remember when we start seeing cap rates dip into the, fours, maybe that's the time we take a step back. Maybe that's the time when we consider some exits, but we also just sort of like slow our roll a little bit on acquisitions until we see what happens, because, buying at the peak of the market, right? It's not where you want to be. So it's a great time to acquire, I guess is my point, if you can make the deal pencil in this new environment.
Yeah, for sure. And I think the uncertainty in the market plays into our favor when we're negotiating. When everything is just, hunky dory and the sellers, they don't see any sort of challenges. That means that the buyers don't see any challenges, and it gives them more peace of mind and generally gives them more, we'll say, courage to step up to the plate and actually, pay a little bit more. But because of the uncertainty there in today's market, I mean, we're seeing a lot of groups now. And I mean, John, we were just talking about this in regards to what kind of cap rates that, a lot of groups are actually looking for, especially for the institutional, space. And the reality is that they're only pulling the trigger if the deals are phenomenal. And,
Yeah.
and
Yeah.
so that leaves deals that we know we can actually put a lot of, we'll call them, sweat equity in regards to the value add into it. There's a really great buy opportunity today. And, the reality is that if the deals pencil out at these higher interest rate environment, then it doesn't really matter what interest rates are, right? They could be at 18%, and if you can structure a deal to have it pencil out, so you can show those 20% annual returns, and you're getting your 5 to 6% cash on cash returns, and you have, you fix your debt, and you have adequate cash reserves, and you do all the right steps along the way. It's like, for me, it doesn't really matter as long as we're hitting our metrics, right? Our key returns.
That's right. Yeah, a couple of things to consider in these markets, right? So when interest rates expand, you often see the lenders become more conservative. So their underwriting criteria becomes a little more stringent. So even in terms of due diligence, just vetting the operators, it's a more in-depth process. The due diligence they're doing on the deal. So if you're not a strong operator and you don't have a strong team that's able to deliver on what they're looking for, we're learning from lenders that deals are getting rejected just because the operator can't produce the level of due diligence required. What's also happened is the loan to value ratios have started to shrink. So in that low interest rate environment, operators were sometimes getting 75, 80% leverage. And now the agencies in particular are often only offering 60 to 65% leverage. So the deals still work, but it means you have to raise more capital. Therefore, you're taking on maybe a little bit more risk there. But what's amazing about a capitalist economy, right? U.S. is a very capitalist country. New companies come in to sort of fill that missing gap, right? So preferred equity or even soft preferred equity, where you can bring in basically another layer of debt. And for the listener who's not familiar with that, generally pref equity works in such a way where you're paying an interest rate on the money current, so in the deal on a monthly basis. So let's just say in today's market, you're typically seeing these groups offer a 14% rate, which seems high. But what happens is you only pay them 7% currently. So it's basically like a 7% interest rate. And then when you exit, you top them up to that additional 7. So that gets them to that 14, that accrued interest. And what's beautiful is that, yes, it is more debt, but they don't participate in the upside. So we don't do it on all our deals. Candidly, we've only done it on one because the deal supported it, but it has the impact of actually juicing the returns for the LP investors, because ultimately, if we outperform and say we have a 22% average annual return, more of that is going back to those LP investors. So, that's what we're talking about when we talk about creativity. Now, you got to be very intelligent and smart when you make these decisions, because not all deals support that type of financing, but you're seeing more of that coming into the marketplace to fill that gap in these lower LTV loans that we're now seeing.
For sure. So to give you guys a better understanding of what, so debt service coverage ratio, this is something that lenders want to ensure that you have adequate net operating income. We'll look at this as like EBITDA in a business. So what your profit is, not including your mortgage payments, it needs to be 1.25 or higher. And so this means that your net operating income is going to be higher than what your debt payments are by another 25%. So 1.25, if you take your net operating income divided by your debt payments over the year, you got to come out higher than 1.25. And so that's what these deals need to be able to pencil out on when you close on it, in order for the lender to give loan proceeds there for you. Now, the alternative, the other thing to think about with these is that when it comes down to getting loans, you have this bridge debt or floating rate loans, where in today's market, you need to buy these rate caps. And these rate caps, what they are is basically like insurance for the interest rate. So if it goes up over a certain amount, it actually means that you lock in how much you're actually going to pay. So it's protection there, but generally they're like 3 years. So the thing with that is you got to really make sure that within 3 years, when that rate cap expires, and if interest rates did double, you got to be able to factor in that you might need to buy another rate cap, where that could be $1 million plus. And so that's where, for us, the deals that we go into, we like getting the 5-year fixed rates. And so by doing that, that just gives a little bit more peace of mind, knowing that if rates were to go up in 5 years from now, we're going to be, just fine. And we're not going to have, we'll say the time isn't ticking, the time bomb isn't, or the potential time bomb isn't ticking. Right. And so that is very helpful. And then we just factor in, if we were to take an exit earlier, we factor in any sort of prepayment penalty that we would have to pay into our overall returns. And so we factor that in. Okay, if we were to exit in 3 years, we know we're going to be paying this amount in penalty. But it's just in today's market with that kind of uncertainty now, the reality is that, there's just more safety. And if you go back in history, you realize that, these interest rates, although they seem really high right now, we're under that average since 71. So, I don't personally think that the rates are going to be going way up, much higher than this, because they've now brought inflation down, but it could happen. And so if it does happen, as all of our investors looking to us as making wise choices, if we don't put these kind of checks and balances and risk prevention strategies into place, if rates were to go up, it wouldn't be a good response saying, well, we didn't think it was going to go up, right? So we got to be able to put those measures in place as a just in case to protect the downside for our investors.
No, that's absolutely right. And I think for us, it's always that conservative approach. But, it's amazing, right? One of the beautiful things about human nature is how quickly we can adapt, right? Now, some people may adapt to change more quickly than others, but, we had a couple of years of these exceptionally low interest rates, and the memory becomes so short, people just think that's what it was. But to your point, we're actually below what the average has been. So these rates are actually normal, and not, the 2 to 3% was abnormal. So, what's also kind of happening, Mark, and it's not something we've done yet. But there's operators out there. For example, the deal we just closed in Charleston, we didn't do seller financing, but the person had built the building and owned it themselves. And so, there is a world that could have existed where we could have potentially negotiated with that seller to take on some seller financing, right? And so a lot of sellers are opening to those thoughts and those suggestions. And so, it's really, once again, about getting creative. But in our world, we prefer just to know what we have, and that's fixed rate financing with a 5-year term. And candidly, if a deal doesn't pencil with the rates we're getting, there was one we were looking at, and we're looking at if we can make it work, but we got a quote in from the agency, and it just was a little bit lower leverage because, frankly, the current owner has been maintaining about 92% occupancy. So that's how the loan gets structured, based on the history, not what we project to do. And so that just killed the returns. So we're going to see if we can tweak it and make it work, but we're not going to start changing our rent assumptions or changing any of the underwriting. It's just, we got to either find a financing option that works, or the deal simply doesn't work. And I think that's a critical component, whether you're buying a single family home or you're investing in one of these syndication deals, is knowing when to walk away, right?
Yeah.
It may look great, but at the end of the day, if it's not there, don't start going in and tweaking. The deal is the deal, and have that approach.
Yep.
And just that's how you win in this business, right?
You got it. All right, John, this has been a great conversation so far. Let's get into what smart investors are doing. Let's break it down for all the listeners out there to be able to protect themselves in this higher interest rate environment. When I say higher from what we're used to over the last few years, not so much higher in the history of, say, from 1971 till now, but how are we protecting ourselves moving forward? And so the first one is that when you're looking at deals overall, what we're seeing out there now and what we're actually looking for, as well as that deals with higher cap rates that are current right now. So that means that the overall return from the project, from the asset that we're buying, they need to be able to have higher returns to be able to outpace the higher interest rates. So that'd be the first thing that we're looking for as well.
Yeah, that's right. And I think, another thing, and it's what we do at Faris Capital Partners, it's focusing on deals where you can force appreciation, right? And that's the value add strategy. So, in today's market, maybe buying that new building with these higher rates could produce some challenges, because ultimately all you're relying on, the building is in its best condition it'll ever be in. So the rents you can achieve are the best you'll be able to achieve. So when you buy a value add, you can force that appreciation. And so at Faris Capital Partners, we love value add. We love finding a C or a B class building in a B or an A location, and then coming in, renovating those units. And now we are a value compared to some of those newer deals, while providing a very similar style unit. So value add is the focus that any savvy operator should be really looking at today. Any investor should be thinking about, where can I force appreciation through renovations or other strategic realignment in the business
Yeah,
operations.
no, for sure. And so for context there, so if you buy something and it hits that 1.25 debt service coverage ratio there, and you go in and you force the income up, all of a sudden within a couple of years, your debt service coverage ratio might be at like 1.5 or 1.7. And so that just means that you can do a refi down the road and you can actually be able to pull money out, or you sell and you're trading at a higher value. So definitely that helps to protect yourself down the road when you need to renew. You can increase the overall value, and that actually creates equity. The next one is locking in fixed rate. We've talked about this quite a bit. And so if you're going to avoid the bridge debt, they're a little bit more risky, especially if you're buying cap rates. The thing is that 3 years down the road, like that's coming due soon. And so you have, we'll say, less pressure to perform getting a fixed rate because it's 5 years. And a lot of times you can get the extension and you can actually pre-negotiate that up front to be longer than 5 years. So it really protects you down the road.
Yeah, I mean, 100%. So that fixed rate, because it dovetails into what you mentioned earlier, where that refinance possibility. So by getting that fixed rate, making sure the deal pencils in that environment, putting a value add strategy into place, you drive the income and you get that debt service coverage ratio up. If rates were to drop even just slightly, but certainly meaningfully, you can always refinance and take some cash out, potentially distribute some money back to your investors, or invest that money back in the deal to continue to drive that value add strategy. So for us, that's much more better than, say, for example, taking on some floating rate debt, even with a rate cap, where, God forbid rates do go up dramatically. And in year 3, we're going to our investors trying to raise additional capital to, pay for that new debt, right? So for us, fixed rate value add strategy, and, looking and monitoring the market conditions. So if that refinance makes sense, we can deploy that versus running the risk of having to raise more capital to refinance, if rates were to go up, right, with a floating rate loan.
For sure. And so if you're a little bit more adverse to risk, then what you can do is lower your loan to value ratios. So that might be bringing more equity to the table.
Yeah,
And
and
so
that's
that,
kind of what we've effectively done on our most recent acquisition. It's the deal's still very strong with that lower leverage. I mean, we still haven't won the deal yet, but we feel confident we will. But we just prefer that more conservative approach, because it goes back to, for us, we want to always over deliver what we tell our investors, and so throughout our process, we're as conservative as possible. And so even sometimes it's enticing, right? Oh, well, SOFR is so low right now. Maybe the floating rate makes sense, but we just slow ourselves down and say, what's right for the investor, what's going to protect them the most, and that's fixed rate financing.
yeah. And last but not least, and John, you might have another one to add to this, is getting interest only periods. So this is something that we do take advantage of to be able to increase cash flow. You can also extend loan amortization periods as well to actually make it so that there's less of a demand on a monthly basis to be able to pay for it. You can more so push it back, and that increases overall cash flow. It basically buys you more time to go in and execute on the value add plan. And so the majority of the upside for us is going in and forcing it. Any sort of natural appreciation that comes, we see that as gravy. That's like the cherry on top, right? But we're not depending on the overall market going up. So for us, doing interest only along the way is just fine, because majority of the upside for us is in the improvement of operations and driving net operating income, doing strategic renovations.
That's right. These are 5-year holds. Potential, our agreements do have an extension option, just that the market conditions aren't correct. But our goal is to get out in 3 to 5 years. And so, doing a 5-year term, in some cases, the first 2 to 3 years are completely interest only. We're forcing that appreciation through additional net operating income. So still delivering those 2x equity multiple. But, we're not necessarily concerned with driving down the principal on the loan, because we know we're driving that appreciation through our renovation strategy.
For sure. Final thought for me here, John, on this
Yeah.
is that, like any business, and that's what every multifamily property is, it's a small business. And in some cases, you're buying a $50 million, it can deal. It's a larger business.
That's right.
They're all businesses. Even if you have a single family property, you got to look at it that way. And so the number one thing that will kill you in any business, the number one thing that will take you out is running out of cash.
Yeah.
And so that's something that I think is overlooked in a lot of cases. It's like, oh, I think it's going to be X amount, but it'll smoke the deal and it'll take you out of this business very quickly if you don't have enough cash. And so that is something that's really important, is to, whatever you're figuring out what that interest rate is, if rates were to go up, do you have enough cash to sustain yourself moving through the whole period to be able to come out of that cycle? And so I think if you get the cash thing right, no matter what, you'll still be able to live another day. But if you get that cash thing wrong, that's the one thing that will take you out faster. Because regardless of whatever the error is, generally it's because you run out of cash, right? So you over predict what the overall returns are going to be. If you have more cash, you can hold on to it longer until the market comes back. If you say over or underestimate what the cost will be, if you run out of cash and you can't pay for it, now you're screwed, right? Yeah. So cash is the number one thing that we look at, and we make sure that we have enough oxygen to be able to sustain any sort of hiccups that come up down the road. And of course, prevention, an ounce of prevention is worth more than a pound of cure type thing, but cash is the thing that will protect you in the long run.
That's right. No, cash is oxygen, and it's one of our golden rules, which we'll get to on our next episode there, but strong cash reserves.
Right on. So if you are interested in investing in real estate and you don't want to do any of the work, go to fariscapitalpartners.com. We are getting closer to our next acquisition. You want to make sure to get on our reservation list to be able to be the first to see that next opportunity coming down the pipe, where we do get the 20% annual returns and the 5 to 6% cash on cash returns, amongst tax advantages and many other benefits of investing. Go to fariscapitalpartners.com. If you do like the show, go ahead and share and subscribe to the channel, where we are building a channel to help high net worth investors invest into multifamily investing. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.